So you can say they are less risky. You can consider mathematically, you can consider them less risky. If you are investing the income that these funds are generating for you, you can invest that income in lower risk assets like bank FDs or debt funds. So automatically your overall portfolio risk gets reduced. Then there are capital protection funds. So capital protection fund will offer uh, protection for a certain percentage of your capital. Let's say 80% of your capital is protected. So no matter, regardless of the market returns, whether the market is giving 50% negative returns or 50% positive returns, your 80% of your portfolio value will be secured. It is guaranteed to return back to you. Some other capital, so 80% I'm just taking as an example. There could be 100% guarantee as well. But uh, if the fund is investing in a risky asset class like equity or gold, they will offer slightly lower capital protection like 90% or 95%. And then there is risk reduction and return maximization. These are the most common objectives of the fund, even if they are not written as a fund objective. Every fund tries to reduce the portfolio risk by adding securities which are more manageable or where the risk is uh, slightly lower, or they are canceling out each other's risk. Return maximization. But if the fund is defining very clearly that the objective is risk reduction, for example, in a diversified debt fund, if risk reduction, lower risk is the objective of the fund is trying to invest in securities which are going to be offering less volatility, like gilt securities, shorter duration securities. And if the fund is vying for a maximum return, they're trying to include securities which are going to be highly volatile, and there is a possibility of higher than market returns in these securities like value stocks, low PE stocks. And then there is portfolio style. So portfolio style is the diversification of the portfolio, whether the fund is holding 30 securities, 25 securities, or it is holding multiple different types of assets in the same portfolio. And then there is long term and short term. So if this is the duration, so long term, short term usually matters most for the fixed income securities. So debt funds are mostly affected by this. If you are investing in a short term income fund, short term debt fund, it will offer lower risk. And a long term debt fund which is holding long term securities is going to be offering more risk, and definitely you are going to expect more higher return from this. So one thing that we need to remember at all the time is